Hey everyone, welcome back to Corporate Decoder, where we strip away the jargon and decode the real stories within company filings. Today we are looking at MetLife Incorporated, and let's just say their latest filing might reveal some interesting forward-looking forecasts that could be more about wishful thinking than concrete plans. And before we dive in, if you want more of these uncensored corporate breakdowns, make sure you are subscribed and join our growing community on Discord. The link is in the description below. Alright, so MetLife, a giant in the insurance and financial services world, has dropped a Form 8. This isn't their usual quarterly report, but rather a current report filed to disclose some preliminary financial information before their official earnings release. They're giving us a sneak peek. A taste of what is to come for the quarter and the full year ending the 31st of December 2025, with the full report expected on the 4th of February 2026. So this is like getting a trailer before the main movie, and sometimes trailers show you the best parts, right? Let's start with something called variable investment income. Think of this as income MetLife makes from more volatile investments like private equity, real estate funds, and certain fees. For the last quarter of 2025, they're ballpark estimating this income to be between $385 million and $435 million before taxes. Now, their target for the quarter was $425 million, so they're looking to come in right around their target, maybe a little lower. But it is the full year picture for 2025 that catches my eye. They're anticipating a return on their private equity investments of about 7.7%. That sounds decent, but then they project for 2026. They're going to assume a 9% annual return on these same investments. A 9% assumed return for 2026 is pretty standard, but the market is always volatile. It means their projected variable investment income for 2026 could be around $1.6 billion before taxes. More importantly, they also mentioned that these variable investment income asset balances are expected to decrease over the next 1 to 3 years. This means MetLife itself expects the pool of money generating this fluctuating income is going to shrink. They might be getting more return from what is left, but less overall. Now let's talk about how MetLife is managing its money, its capital. Their top priority is always to support growth within their existing business. They've put an estimated $4 billion towards this in 2025, which is a significant amount. On top of that, they've added about $1 billion for mergers and acquisitions, including the big one they've been talking about, buying PineBridge Investments. That acquisition is still expected to close. Looking at shareholder returns, they anticipate buying back about $2.85 billion of their own common stock for the full year 2025, with $430 million of that happening in the final quarter. And they're signaling that they plan to continue buying back stock at a similar pace in 2026. This is a common strategy for stable companies to return value to shareholders, especially when they might not see a lot of explosive organic growth opportunities. It signals confidence, but it also means they don't see alternative uses for that capital that would generate a higher return. Here comes the legalese and the important disclaimers. MetLife is very clear that this preliminary financial information is an estimate. They haven't finished their official financial closing procedures. This means the actual numbers could be quite different. They're telling investors to be cautious and not to read too much into these preliminary figures. They also emphasize that these numbers are not a substitute for their full financial statements prepared under US generally accepted accounting principles, or GAAP, and they are not necessarily a reflection of future performance. This is standard practice, but it is crucial to remember that anything labeled as preliminary or a forecast comes with a healthy dose of uncertainty. The company's outlook depends on assumptions about future economic and business conditions, which are full of known and unknown risks and uncertainties. They are constantly reviewing their assumptions and have plans to deal with problems, but they can always change their outlook if conditions change. This is why we always look at these filings with a critical eye. They're managing expectations and hedging their bets in case things go south. Finally, we get to the signatures, which is essentially the official sign-off from the company's leadership. Adrian Wunnell, Executive Vice President and Chief Accounting Officer, is signing off on this report dated the 22nd of December 2025. This confirms that the company is formally submitting this information to the Securities and Exchange Commission. Now let's cut through the noise and get to the core of what this filing tells us. MetLife is navigating a complex economic landscape. They're projecting solid, though not spectacular, performance for 2025, with a significant chunk of their capital going into supporting existing businesses and acquisitions like PineBridge Investments. The buyback program signals a mature company looking to return value, and perhaps signaling that organic growth has reached a point where reinvesting all profits back into the business doesn't yield the highest returns. The biggest red flag, if you can call it that. is the forward-looking statements while they are providing an outlook for 2026 with a 9% assumed private equity return. The mention of decreasing variable investment income asset balances suggests a potential slowdown in that area. This could be a smart move to de-risk the portfolio, or it could be a sign of challenges ahead in those specific investment types. MetLife is playing it safe and strategically as large financial institutions often do. They are investing in growth through acquisitions, which is sometimes a more reliable way to expand than purely organic growth. The buybacks are a sign of financial health, but also a lack of groundbreaking new ventures. The real question for investors is whether the economic outlook MetLife is betting on for 2026, especially in private equity, will materialize. The trend of decreasing asset balances in variable income is something to keep a close eye on. There is always a risk when companies project future returns, especially in volatile markets. That is our decoder for MetLife Incorporated's latest preliminary disclosure. What is your take on these numbers and what they signal for the company's future? Do you think their growth strategy is sound, or are there hidden risks? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And subscribing ensures you don't miss our next deep dive. Don't forget to join the conversation and connect with fellow enthusiasts on our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next decode.